Troy Boisjoli, CEO and Director of ATHA Energy. ATHA is a large-scale exploration company focused on assets across North America, primarily focused in the Athabasca Basin, the Thelon Basin, the Central Mineral Belt. In Labrador, we've amassed the largest exploration package in the industry, and we have a very aggressive growth strategy going into this very favorable uranium market.
Right. Good to see you again, Troy. Busy out there, very busy, lots of M&A, people are excited. We've seen a little setback, a reset at the moment in terms of pricing, but I think the thematic seems to be very positive indeed. Now, you mentioned it, you've got a very large portfolio. So how does this contribute to your overall strategy and potential for new discoveries?
Yeah, we have around 8.5 million acres of exploration property across the best uranium jurisdictions in Canada, chiefly being the Athabasca Basin and then into the Thelon Basin. Our strategy is to aggressively grow at the early stages of this uranium macro market, which we feel has been and is the best uranium market that any of us in the space have ever seen. So, Matt, to your point, based off the size and scale of the land package and a systematic approach to exploration with the team that we've built, we believe that our opportunity for growth through discovery is very good. But that's also backstopped by one of the highest grade mineral resources outside of the Athabasca Basin in the Angilak project that has 43 million pounds at 0.69% U3O8.
Right, and I want to get on to Angilak in a second, but first, just in terms of this kind of growth strategy, I mean, how are you balancing the kind of an aggressive expansion program along with risk management?
Yeah, so what we do is we have invested heavily in geophysics, over the last, call it 14 months. We've done more geophysics than I think any other company. And the reason for that is to build up a very large data set to be able to assess, evaluate, rank, and prioritize our key projects. And those key projects that we have, Matt, we're going to drive exploration through those projects as ATHA individually. Okay. And then you think about from a risk, from a size, from an execution perspective, what we're also doing then is we have the ability to pull value forward within our exploration portfolio through farm out agreements. So we have 3 agreements on the books that pulls that exploration value forward in the properties that aren't in our, say, 3-year window. And as a function of that, it's a strategy that looks to maximize discovery within a single investment based off our land position, based off the amount of work that's getting done.
Right. Okay. I'm coming on to Angilak then. In terms of, can you just go to expand a little bit more as to how it fits into the overall project portfolio? Again, what potential do you see there for additional development discoveries?
So Angilak, where it fits into the overall portfolio. So if you think about, let's contextualize our strategy and our portfolio versus, let's say, the Lassonde curve. Okay. And you look at where we're at with our internal investment relative to the Lassonde curve. We're investing most heavily in Angilak because Angilak's our most advanced project, 43 million pound resource and growing. And then you go down from there, we're investing in our Gemini project, which is a post-discovery project in the Eastern Athabasca Basin. And then down from there into our generative stage projects. Okay. So it is a risk-adjusted investment portfolio internally on how we're investing in projects. And then Angilak, specifically, how are we addressing that? Okay, so there's a 43 million pound resource there. And what we did this year was focused on aggressive growth. So we went into Angilak, we did not do one delineation hole. They were all widely spaced drill holes, all focused on materially growing the mineralized envelope of that mineralized system. And that's exactly what we did. Okay, so we put 25 drill holes into it, just over 10,000 meters. Every one of the holes was successful in expanding mineralization and very materially expanding that footprint.
Right. Okay. And just on that, you've coming back to the kind of size of the land package, and some people would argue that's a big liability you've got there. So how are you positioning that strategic land position to benefit your company?
Hey, that's a very fair comment, Matt. And I think in a different uranium market, you would have to consider the size and scale of the land package much differently. In this uranium environment, with the macro, the way it's stacking up, with the upward pressure coming into a contracting cycle, upward pressure on spot price, etc., we don't view it as a liability whatsoever. We view it as a tremendous asset. And as a function of that, we're investing heavily in maturing that asset rapidly by focus on high grading, if you will, the best targets out of the best land, or out of the largest land position in the best uranium jurisdiction in the world. We very much view that as an asset, and in doing so, that's where our strategy relative to investing internally, in focusing on discovery through ATHA independently, through working on the best projects comes from. And then in turn, that's where the farm out strategy comes as well. Maximizing value, pulling value forward by having outside companies earn in on projects where we retain exposure to the upside, exposure to discovery.
Right. And what does that mean for your balance sheet in terms of de-stressing it or adding value to it?
Yeah, it adds significant value. We've got around $30 million in farm out agreements currently on the books. And that's a material amount of exploration investment that's going into the ground that we have exposure to the upside. And then when you talk about optionality within our portfolio, Matt, you also have to consider we're in a unique position in that we have a 10% carried interest in a significant percentage of NextGen Energy's exploration portfolio. Those in the uranium space would know NextGen. I personally came through there. I was the vice president of exploration for a number of years, and we have a 10% carried interest on a portion of that portfolio, which we like as an option. They've been tremendously successful in making discoveries over the last cycle, and we expect them to be aggressive in that exploration on a continuous basis, on a go-forward basis. So exploration in general, we view that exploration portfolio brings a significant amount of torque to ATHA while we are focusing on expansion at Angilak, which is a mineral resource that we feel is moving into a development stage.
So if I look at that, you seem to have a risk management approach to the kind of construction of that overall portfolio over time. I mean, how do you view that? How should we value that?
So I think first, from a value perspective, you have to start with what we have pounds in the ground. 43 million pounds, one of the highest grade resources outside of the Athabasca Basin. And then moving forward from that, you look at the exploration portfolio off the back end of that. And that becomes torque. That becomes value torque. The ability to make additional discoveries within that land package is high. At the same time as we are moving and expanding Angilak, we're also going to continue to explore. But based off of that focus, we view that exploration has more asymmetry to the upside than to the downside as it relates to our capital market strategy.
Right. Okay. And you hit upon something there, which I think is really important. Bit of chatter in the market about the reality of a lot of the projects that have been talked about actually ever coming into fruition, ever getting built, ever producing uranium. Talk to me about you and your team's experience. Why should we back you?
Yeah. So for myself, I've been in the uranium business a long time. I came up through Cameco Corporation. I was an exploration geologist with Cameco. Went from exploration over to operations. Had the opportunity to be a production geologist or the chief geologist at one of their operating mines. And then from Cameco, during the downturn in the uranium market, had the very good fortune of joining NextGen and developing the Rook 1 project from the stage of maiden resource right through to feasibility, including resource growth, exploration, the engineering work, as well as wrapping around all of that, the very important engagement work and work with local Indigenous communities. From there, our vice president of exploration is a guy that has never participated in a junior company. He has been with Orano, he has been with Cameco, and he was a principal at SRK as a qualified person on a number of uranium resources globally. He was a chief geologist that brought Cigar Lake into production. And then you go down within our technical team and we have a group of 15 to 20 year geologists that have either been exploring for, discovering, developing, or producing tier one uranium assets their entire careers. So from a technical perspective, we have a very strong team that is more mature than our asset base right now, which is very important for us to be able to understand what the next steps are and how to drive projects forward in a real way. And that is I'm a technical guy, so I can appreciate the technical side of it. But what I appreciate more is the capital market side. And the capital market side of our team is very strong. It's self-evident. We've raised over $55 million over the last kind of 18 months into ATHA alone. Gives us with a very strong balance sheet, very good access to capital, etc. So there's both sides of it. There's the technical side and the capital market side of our team, which is very strong.
Okay, well, and talk to me about that team and the steps that they're taking to help you transition from explorer into developer, given this uranium cycle we're seeing now. Are they going to be able to time it properly?
Yeah, I believe so. I look at the timing, particularly in the near term relative to an emerging contracting cycle, which let's think back to the previous cycle. The catalyst for price appreciation, spot price appreciation, and growth was really a contracting cycle. And we're on the very early stages of that contracting cycle. So yeah, the ability to have a team in place that can aggressively expand with intelligent, knowledgeable expansion on an asset that makes sense. And Angilak does make sense when you boil it down and look at the grade profile relative to the geologic setting, relative to the growth profile. It all makes very good sense. And so now it's about the forcing function is expansion and it is growth. And we've materially de-risked that this year through the exploration program that we had in stepping out and expanding that mineralized footprint, and now having the ability to come back in and focus on the next stage, which we're working on right now, but which will likely be aggressive delineation.
Right. Okay. And you've said you understand the importance of the kind of capital markets in all of this. Can you just talk about the kind of current share structure and capital structure within the company, institutional ownership, etc.?
Yeah, so we've got right around 277 million out. I guess first let's back up. We're a new company, from a cap table perspective. We're a very new company. We started trading April 11th of 2023, and so that has its advantages. Having that newness. So we've got 277 million out. How we got there is about 134 as ATHA alone. Then we made two acquisitions. We acquired 92 Energy and Latitude Uranium, issued about 65 million shares apiece to those companies, getting us to our current range. Within ATHA alone, we had no warrants in the system. We do have about 10 million warrants in the system currently, but those are at as a function of the acquisition of Latitude. Those are at an average strike price of $1.85 due to the conversion ratio. When you think about founder internal ownership in that range, just under 25%. Institutional ownership, last time we summed it up, about 27%, with some of the people that you would expect that have been in the uranium business a long time and are, I would consider, some of the most knowledgeable institutional investors in the uranium space. But then beyond that, we also have some large institutional ownership that is, from participants that I would say don't usually play in, our market cap. And are participating based off of our growth strategy and where they view the sector going and where they view ATHA going.
Yeah, well, actually, we'll come on to that in a second, actually. But first of all, just you mentioned in a bit earlier, this kind of perception, you might argue misconception about the ability to business there. I mean, how would you address any concerns about developing projects in the region?
Nunavut is a very, very friendly mining jurisdiction, and again, it's one of those things that when you look at it, becomes self-evident. They built multiple mines in the last cycle. Nico Eagle's been leading the charge there recently. Just under 50% of the Nunavut GDP is a function of mine production and natural resource production. Okay, so very favorable mining jurisdiction. It is one of the core industries, if not, well, at almost 50%, it is the core industry, I would argue, within the territory. And then from a uranium specific perspective, our Orano, the third largest uranium producer in the world, has a project there that went through, in the last cycle, went through a bankable feasibility stage study, went right through a regulatory process. Due to market uncertainty as a function of Fukushima, did not have a regulatory, or did not have a final investment decision pinned down because of that. And so as a function of that, step back from the process. But that gives you an indication that both from the ability to build mines, the ability to execute operations, and from a regulatory context, it's a very stable jurisdiction. It's a very stable jurisdiction within Canada, and then you contextualize the Canadian jurisdiction versus the global jurisdiction, and it's one of the best.
Right. Okay. I want to talk about again. I'm sort of picking up points as you say them. Just want to pick up on coming back to this kind of large land package and that your kind of your systematic method, the efficacy of that and the allocation of capital. Can you sort of just break that down in terms of you've got a bunch of money, you raised a lot of money out of the gate. Now you've got to be really smart with how you allocate that. Can you sort of explain what that looks like?
Yeah. So what we're doing, it's a balance, right? It's between how we're allocating it in a value accretive way within our portfolio, and then aggressive growth relative to where we view ourselves in this market. Okay. And so as a function of that, we're investing $30 million into exploration directly into the ground this year, which is one of the largest, it's certainly the largest within, call it our comp ratios, in terms of what we're investing into uranium exploration. Now, how that's done is 40% of that is going into our most mature projects. Okay, so 40% of that's going into Angilak. 30% of that's going into Gemini. Gemini is a exploration property with a recent discovery on the eastern edge of the Athabasca Basin. So that's torque. And then the remaining torque comes from 30% being invested into our generative stage projects, our land package, maturing our exploration targets. And as a function of that, what we're building up is a very large pipeline, an extremely large pipeline of de-risked exploration targets, again, from the largest land position within the best uranium jurisdiction in the world.
Right, but how do you evaluate those projects in terms of how much emphasis do you put in place in terms of what future margins could look like? Because it's quite important in the uranium sector. People have got reviews on what price will look like and what costs will look like, and therefore will these things be economic? How do you view them now whilst you're searching for them?
Everything that we do is focused on real opportunities. Okay. And we know in the resource sector that there are opportunities and then there are real opportunities. And we believe that Angilak is a very real opportunity for us to move a project forward into a development stage through growth. And that's because of the foundation of the resource. Both Cliff and I, our VP exploration, myself, have mined in the uranium space. We understand the operating cost structure of different assets. And when we look at Angilak as a foundation, okay, Angilak has 16, at 0.69%, that's 16 pounds of uranium per ton. You can do the math on that pretty quickly based off modern prices and get to the value that we're looking at in terms of the potential value of the rock. Okay, and then from there, you look at what some standard operating costs would be within a typical underground uranium mine or uranium operation. And we like those margins, with the work historically that I've done. You look at ranges, say in the $300 to $400 range on a per ton basis. Well, you look at the value, 16 pounds per ton. You look at that cost profile or operating cost profile, and then it becomes a very clear critical path for us. And that critical path is resource expansion and resource growth to get us to a tipping point to move this thing forward into a development stage. And that's why we had the strategy that we had this year, as opposed to focusing on incremental resource growth going from 43 million pounds to say 55. We focused on expanding that envelope of mineralized rock in a material way, which then in our mind, in our view, technically de-risks that next resource growth phase, which is focused on a step change resource that gets us and kicks us over into that development stage.
Well, sitting with a big kind of capital of $30 million on exploration alone, I guess you have the luxury of doing that, where maybe more cash concerned companies haven't, but you must also have a view on the current state and future outlook of the uranium market? Lots of M&A happening. How do you read the landscape?
We assess that constantly. We have a very aggressive growth strategy. That aggressive growth strategy has to be checked continually versus where we view the macro market going. And the bottom line is we just came through that phase again, after 2024, the spot price running up to over $100, settling down at about $80. But the real story there is that the long-term uranium price has continued to tick up the entire time. And we look at a near-term time horizon where we're in a structural supply deficit. That structural supply deficit is real. And overlaid on top of that, we're entering into a contracting cycle where utilities have not yet reached replacement rate contracting. So still contracting under their replacement rates that they need on an annual basis. And the amount of pounds on the demand side that are become uncovered under contract between now and the next couple years out. I'd welcome people to look at that. It is directly comparable to what we saw in the 2005, 2006 run up into the 2007 time period. But the biggest difference between now and then is the market sentiment has changed completely around the need for nuclear. And the build out that is happening right now in Southeast Asia, the demand increases that are coming, the demand stacking that's coming in Asia. But I think more importantly, from my perspective, that's been known for a long time, Matt. That build out's been happening for a long time. The thing that's been the inflection point here in the last couple of years is that you've had a curtailment and a reversal of demand destruction within the Western world. 4 or 5 years ago, utilities were shutting down reactors in the U.S. and had a decommissioning plan that is reversed. The typical example in the last week has been reactors coming back online on 3 Mile Island. So from a macro perspective, this is a very, very bullish uranium landscape. Better than we've ever seen. The near-term catalyst, in our view, is that contracting cycle that we're about to emerge into. And then you look back and comp that back to the last cycle with the contracting cycle. And that's where in 2007, we saw the price run up to $135 a pound.
Absolutely. And it ran up to 106 earlier this year, but it's going to retrench somewhat, resting and ready to go again, I suspect. But when you look at the market now, where are these pounds coming from? And if they can't be found, what's that going to do to price?
There's only one, that's the asymmetry that we really like in this uranium market, right? Historically and traditionally in the uranium space, and understandably, I'm a bit of a uranium nerd, having been in the space for a long time. The risk in the uranium market has traditionally been on the demand side. Okay, we have reached an inflection point where it is now transferred to supply side risk. Okay, you look at what has happened with the major producers over the last couple of years, for instance, Kazatomprom. Okay, Kazatomprom year over year has revised down production forecasts. Well documented concerns around acid availability as it relates to supply chain, therefore affecting production. Cameco has brought McArthur River back online and is focusing on achieving production this year. However, last year fell short of that production. They have 2 operating assets in Canada that supply a significant amount of that material to market. 2 assets that represent a large supply, and then where the gap has to come from, or that supply demand gap, how to close that has to come through new production. And new production in the mining world is challenging, right? It's challenging in terms of timelines, in terms of cost, in terms of regulatory, and in terms of execution. So we view squarely that the risk right now is sitting on the supply side. And even if you look at the tier 1 projects globally. Okay, Arrow, for instance, unbelievable asset. It's going to come online without a doubt. Arrow production is coming into the uranium market, but it's already accounted for. It's already accounted for, and we need more production than Arrow over and above that. Other incremental sources absolutely are needed to come to the market. and we still need more. So when you look at the resources that are currently on a development stream, absolutely required and more. And so, the time to aggressively invest in exploration and development stage companies or projects in the uranium space, that's why ATHA came to the market. That this is exactly why we came to the market at this time with this strategy.
If I look at so what's happened in the past few years with regards to kind of government intervention, it's going to and ESG, it's kind of dragged out the time from discovery through to production to about 18.6 years. If I look at some reports, it's a long time. Do you think that we will see maybe governments getting out of their own way, as we say here in the UK, to actually help some of these projects get into production sooner, because it is lights out time?
I do. I do see that for two reasons. One, kind of boots on the ground. We stay close to that at ATHA. I've had the opportunity to chair the Saskatchewan Mining Association Exploration Board for the last number of years. Stay very close to policy, both at a provincial and a federal level. There is real discussions, real conversations happening around red tape reduction. How do we optimize a very robust regulatory process, et cetera? And so I think that will occur at a policy level. I don't think it's there yet, but I think it will occur, and it's coming. In particular, as call it the energy market share of nuclear expands and the need for security on that supply chain becomes paramount. So yeah, I think that will happen. But then also, you look at those discovery through production numbers. And you have to then also overlay commodity cycles and economics on top of them. The Rook I project advanced very quickly through all stages in an optimal way. We've seen that progression and growth, but we also have to understand that was during a decades low, multi-decades low uranium market. And if you solve for economics and are in a very robust market and have a very direct and clear path forward, and that uncertainty that exists around timing and need for production coming online is solved for, as an organization, it gives you the ability to put your head down and work through this and optimize for timing and optimize for timelines. So I think two factors: a robust, bullish market, and the emphasis and need for it at a policy level. Those things combined will help to shape those timelines.
Okay, and the other thing is build. Obviously, companies like ATHA go and make discoveries, move it through development phase, ready to get built out. When you look at the landscape out there, do you see many mine builders? Your ex-Cameco. You've probably got a few contacts, but there's not a lot out there in terms of where you find people who can actually get these things into production, it seems. Are you concerned about that?
Hey, I'm not, because I think that the market will solve for that, right? And the market will solve for that. There needs to be more uranium mines built, and so there will be more uranium mines built. And the lack of uranium mines built over the last number of years, and then you translate that into the companies that have built them, is directly a function of the market that we came through. And so the skills and the abilities to build operations, to build mines, they still exist. I've worked with a number of them historically over the last number of years. People that have the expertise, have the ability to execute, have the technical ability. We're in a very fortunate position with ATHA, and that our head office is in Saskatoon, Saskatchewan. There is. I would argue that there is not a higher concentration of uranium subject matter expertise anywhere on the globe than there is in Saskatoon, Saskatchewan. So we're in a favorable position from that perspective as well.
Okay, well, I'm sure we could talk for the next 4 or 5 hours on the macro thematic. I know we do every week. I'll let you have the final word. There's a lot of new companies coming through, and if the uranium price goes again, there'll be a lot more on top of that as well. What differentiates you from other junior uranium explorers in the market?
I think it's our approach. It's an aggressive growth strategy focused on doing real work and advancing real projects, backstopped by a technical team and a capital markets team that has the ability to execute. that are managing and growing an asset base that is the largest in the uranium space, across the best uranium jurisdictions out there. And I think, from a capital markets perspective, Matt, scale is important. You look at scale and the ability from the size of the company to continue to be able to execute on the size of the portfolio that we have. And we've got all of the right foundational components, and, have done a tremendous amount over the last year to significantly de-risk our portfolio. And now, we're squarely in a position to execute.